Hey, so the market is down by a lot, and there are some factors at play. There are some things that you really need to know, and I have some tools, tips, and tricks to help you manage this particular time. So first, we hit a what's called a circuit breaker. When the stock market drops a certain percentage, they pause all trading. They don't let anybody do anything for about 15 minutes. If it drops further, they do it for 20 minutes. And then if it drops, I think it's 20% or more, they just close the whole stock market for the day. So this is something that has happened before. It does not happen often. It is a big deal. And I want to help you to manage this time. I have three things you need to do, some things you don't want to do at all, and give you a bit of perspective. So as always, remain calm. This is not a time for you to panic. I don't care what it is. This is not a time for you to flip out and do all these crazy things. Number one, if the majority of your money is in your 401k and you're panicked and you're trying to go to HR, if you're trying to go to your benefits department and sell, it's too late. It's always been too late. Reason is, and I don't think that's the best thing for you to do either. The reason is that is in a mutual fund. Whatever happens today, when you hit sell and you trade, it's not going to flip and it's not going to do anything until tomorrow. So don't worry about it. Just let that continue to let it ride. I think most investors for the long term should let it ride. So number one, the stock market is improving as we're doing this video. You can see here when I was getting ready for this video and I was writing emails and getting ready for it, it was down like 7%. It was down 1,700 points, and now it's 1,400. Now, does that mean it'll be up by the end of the day? Absolutely not. I don't know what's going to happen tomorrow. However, we know that you don't want to panic because these things can flip. Last week or the week before, we saw it was down like crazy, and the next day it was like a record high. We don't know if that's going to happen tomorrow. We don't know if it's ever going to happen again. We do know that you should urge calm and just rely on history and rely on what we know happens in these particular times. So first, I want to let you know what's going on and why, and then give you three tools and things that you can kind of do now. So number one, we know the coronavirus is out there. We know that it hasn't helped businesses, and now the fear is spreading. We know it's starting to spread in the U.S. We have some in Washington. It hit Houston. It's in D.C. A lot of people being quarantined in New York. These are the things that are at play. And the fear is, and what has always been the fear is, these things start to slow down businesses. If they start to slow down enough business, then maybe we hit a recession. Maybe it's a global pandemic, which it kind of already is. And what happens when these things happen? So I always bring it back to Nike, because it's a company that we know and understand that 25% of China's business, 25% of Nike's business is in China. If 25% of one out of every four shoes aren't being sold and they aren't being made, Nike is going to suffer. And those things start to play out everywhere else. If you can't work remote and you have to make something, if you're making iPhones, making shoes, making computers, things of that nature, you can't have people in your factory to make it. They're not going to sell those things. If they don't sell those things, they don't make profit. If they don't make profit, bad things happen. People could get fired, so on and so forth. So these are the economic things that people are afraid of. So that's number one. That's something we've already talked about and seen and heard. That's why the market has been up and down over the last two and a half weeks or so. The second thing, and I'll click here, this happened last night, is oil prices have tanked overnight. Basically, OPEC, which is, it's like an oil gang, to be honest with you. It's some of the largest oil producer companies, or countries rather. They didn't get a deal done with Saudi Arabia. Saudi Arabia said, I'm going to cut my prices. And now OPEC feels like they have to cut their prices too. So the price dropped between 20 and 30%. Now people are worried about that. And that affects companies like ExxonMobil. It could affect airlines. It may actually help the airlines. But airlines are also suffering from the coronavirus. And, that's a lot to go on. This is why the market just plummeted like it did right now. Those two things, plus they had to pause trading, so everyone's afraid, everyone's selling, everyone's acting a fool. So here's what you need to do. Number one is relax. Just like I always say, don't panic and don't make emotional decisions because the market is acting a fool. The market does this from time to time. it is doing this a lot recently because of the virus. Now, I'm going to relay this as something I said on Twitter and something you need to know. Right now, you're seeing memes and people who are booking trips to Cancun. They're going to Paris because the price dropped. Because the flight was here and now the flight price is here. You can get, I don't know, I'm making this number up, a round trip ticket to Paris right now for $250. You know that's a $1,200 ticket at minimum. The stock market is very, very similar in that you know that trip is valuable. You know, if you get this trip in a year or 2 years, that trip is not going to be $250 or whatever it is. The stock market is very similar. I know, and you know, that Apple and Nike are very valuable, but today the price is low. When the price is low for a flight, you jump in and you buy it because you know it's more valuable. When the stock market drops in and you know the company is valuable, y'all run away. It's the same logic. You don't necessarily want to run away, but you also don't want to put in a whole bunch of money right now and hope that it hits tomorrow. That's not going to happen. So I'm going to give you 3 strategies right now. We're going to go to the whiteboard. I apologize for my handwriting and whatever spelling errors that I may or may not make. I was not a spelling bee champion, but I know these numbers. So the first thing is defense. So there are certain defensive stocks. There are a lot of them out there, but I just want to give you just a few ideas. This is not a suggestion for you to go buy these stocks today, but I'm giving you just a general outlay of when the stock market does things like this. If there is a recession, these particular stocks tend to do better. They tend to do well because whatever happens, you still gonna have to go here. These things are still gonna happen. So I have, I think, 5 of them and I'm just going to write them here. And these are what are called stock symbols. So I'm just going to write the letters. You can go look it up from there. So the first one is Waste Management. Waste Management. Their stock symbol is WM. They are the company that takes out the trash, takes out the garbage. Regardless of what's going on, somebody has to take out the trash. And the reason I say that is because you can't, unless you're in New York, you can't let the garbage and stuff fester. That makes health crises even worse. Waste management tends to do well in times of volatility, in times when the market goes down, because again, regardless of what the economy does, like these things have to happen. So waste management is one of the better defensive stocks. Also, which you could probably guess this one, Walmart. Walmart gonna be open. Walmart's gonna be there for you. It don't matter if they're gonna have one lane open. Is it supposed to be a dash here? Sorry. Doesn't matter if it's one lane open, if it's self checkout, you're gonna need to be at Walmart. Walmart tends to be a very good defensive stock. You can go back to 2008, go back to any time when things like this happen. Walmart tends to do well over time. Another one is Eli Lilly. I'm not going to pretend to spell that. That is LLY. They're a healthcare company. Then you have Procter and Gamble. Their stock symbol is PG. Procter and Gamble sells and makes almost anything. So Tide, paper towels, anything you think of that you need around your house, especially to stay clean. Procter and Gamble is likely going to be in there. It wouldn't shock me if they made Lysol brand too. Don't quote me on that, but this is a stock that does very well. All of these pay dividends, if I'm not mistaken. This kind of helps you in times like this. And then surprisingly to some people, AT&T tends to do well in times like this as well. So these are just 5 ideas to kind of insulate your portfolio. This is not a suggestion to go out and buy these today. I ain't telling you that. I'm just giving you some general stock market ideas to kind of insulate your portfolio and give you some ideas of what to look for as I'm talking and spelling. All right, that's how you spell Eli Lilly. So these stocks tend to do well because of just because of market volatility, because of what's going on. So these are just ideas. These are things in general. I like to have these in my portfolio or in my investments regardless. It's so, for example, if I own all these stocks already, maybe I'm putting a little more in Walmart than I normally would, a little more in Procter and Gamble than what I normally would. So these are just things to be aware of. There are stocks that do well when the market is not doing well, whereas some, like in Amazon, the tech companies, a Tesla or something, they just do well in general. But when things are like this, they tend to be a lot worse off. These five stocks do not. There are several more. This is just an example of those. Again, not telling you go buy them. This is just something you want to be aware of. So to move to number 2 is diversify. So what you don't want to do, I'm going to go back to the screen. What you don't want to do is, and this, you never should have done this to begin with, is have all of your money in one thing, all of your money in Amazon, all of your money in whatever it is. The problem with that is when the market goes down, all of your money goes down with it. You want to spread that risk out. In general, if you're investing in individual stocks, you do not want to have more than 5% in any one stock. When you're at 10, 15, 20%, that's a fifth of your money or fourth of your money in one thing. This happens a lot with people who work for a company and have the stock option. So like I work at a Cisco, and you put in X percent. So like over time, half of your money is in one stock and you didn't necessarily intend that. You have to protect against that. That's, again, I wouldn't put more than 5%, even if this is the company I work for. You want to diversify yourself and be very, very careful of putting everything in one basket. When you do that, that's when these things happen, you're hurt, and you're hurt more often, and you're hurt more severely. That cut is a lot more deep if all your money is in one particular thing. Now, it looks like Robinhood has also went down. The investing app, that is not great. They were down. They were down the other day because there were some glitches for Leap Day. So there's that. It is not a great day, but again, remain calm. We're going to continue to go to our third step. So diversify is extremely important. This also helps to improve your performance. And then this right here, dollar cost average, is one of the most important things to do. So DCA is what they call it. Dollar cost. Dollar cost average, also known as DCA. Essentially, what this does is allows you to invest based on the dollar amount, and you are consistent throughout the dollar amount versus putting in what's called a lump sum. You do not want to invest a lump sum, especially in a time like this. For example, if you got $10,000, today is not the time for you to drop that $10,000. I don't think even on a good day, I don't think there's any one time for you to drop a ton of money in the stock market at one time. What I would suggest, and this is based on data too, is that you spread that cost out. So instead of, let's just say, $1,000, at one time versus, let's just say, $100 a month. So there is actually some data between 2015, it was 2006 and 2015, where they measured what your returns would be if you invest in the stock market and you put in one lump sum versus just that same amount, but over time. The returns are, or would have been, you would have gotten 10%, and this is through 2008, mind you. You would have gotten 10% versus, I'm going to erase this here, versus just 7%. So DCA, or dollar cost averaging, does benefit you over time. The reason why it does that is it buys more of the stock when it is low. So you get more shares when it's low and you get less shares when it's high. So that kind of balances you out. And I will attempt to draw a graph on what that means. And this also happens in your 401k. So if you're investing 10%, that 10% is coming out every month or however it's divided for you, and that's going to benefit you over time. So for example, let's just say this is, technically this would be time, right? And on the left-hand side would be just price. I told you my handwriting is terrible, so I warned you. PRICE. There we go. All right, so right now we know stock market started off, it was good, and now it's not doing so great right now, right? Okay, so and it's going to do whatever it's going to do from here. Now, when you dollar cost average, I'm going to use blue, and we say, just to make the math easy, 100 per month, right? So we know when you buy things when it's low, you're going to make more money when it starts to go high. If you bought a stock here and it starts to go up, from this point, that's not going to help you. It's going to take a very long time for you to really make money if you bought here and then sold here, okay? So we're going to do this. We're dollar cost averaging. Let's say that it is, let's call it $100 a month. Say this is what you're buying at, and you're buying the stock at 100. So you're going to get shares here. And if the stock goes above 100, you're getting less of it. So you're getting just a piece of it. So instead of getting, let's say, I hope this is a great analogy because, I know how people are with charts and graphs. So let's say you get 10 shares here. When it's above right here, you may only get let's just say 2 shares because it's above 100. And it comes back down, you get another 10 shares. And then the next month, if it continues to go down, then you're getting 15 shares. So you're buying less when it's here at 2, and you're getting a whole bunch down here when it's 15. So that means that whenever the stock market does recover, and we know it recovers over time, the particular stocks that you got here at 15 that were cheaper than 100, the ones that was particularly here at 10 and 10, you really would have made a lot of money on those. You would have gotten some money out here at $2 a share, and let's just say it's at 200. Oops. So you would have made more money by just staying consistent here at 100. So if it's $100 a month, 10% of your salary, whatever it is, this is what's going to keep you balanced out. So even if the stock market is really high, you're not concerned about it. You're not buying at a price that's going to hurt you, and you're not buying when it's too high. What a lot of people do is they sell right here and then wait for it to come back up, and they buy it when it's more expensive. If you're buying at 100, you're avoiding that. And that's kind of how dollar cost averaging works. So those are your 3 things. Go back to the regular screen, and we can check the market too and just see where it is right now. Can hit refresh for a second. Okay, so we're at 14. So it's come up a tad bit. So those are the three things. You want to diversify. You want to make sure that you have some defensive movements and defensive stocks in your portfolio if you don't, and you want a dollar cost average. That's going to keep you even. So if you are investing 10%, if you're putting in $100 a month, continue doing that over time. That's going to benefit you. As I showed you from 2006, 2015, you would have made 10%. Whereas if you just dropped money in one time and left it alone, you would have only made 7. Both were profits, but that extra 3% can make a difference when it's times like these. So be very careful. Those are your 3 things to kind of play around with, to kind of research with. But again, remain calm. I do not think that this is a time for you to just dump a whole bunch of money into a particular stock. You can dollar cost average if you want to do that, but I don't think it's a time for you to up and sell and quit. We've been through this before. I talked about Ebola and swine flu and SARS and all those things. We've been fine over time. But it's also not time for you to sell what you currently have. Doing that, when you do sell what you currently have, you're going to wait and you're going to miss out on a lot of great moments and days. You're just going to buy it when it's more expensive later. A long-term investor, it doesn't help you too much. It does help you if you're continuously investing through this time. If you're still putting money in through this time, when the stock market recovers, you're going to be better off. We have 100 years of history to show us that exact case. So do be careful. If you are buying something right now, that's fine if you're a long-term investor. However, no, just like the flight prices, you could buy a round-trip flight for 100 and you turn around and it's 85. That's not fun, but it can still go lower. That is a thing. Be aware of that if you're a long-term investor and you're thinking about jumping into the market. So those are my tips for today. Stay tuned here on the page. Click share, subscribe. www.buildingbread.com/free. I send out, when things like this happen, I send out like a weekly, here's what you need to know. So I'll write that down here. I really should have just typed it. So you can go there. You get stuff like this almost every week. And I keep you updated with what's going on in the market. So I'll talk to you soon. If things continue to progress, you will hear it from me again. So again, click like and subscribe, buildingbread.com/free. And I'll talk to you guys later.